Welcome to Trading Nation. I'm Mike Santoli. A volatile start to 2019 for the stock market, and one of Wall Street's biggest bears warns the market's erratic behavior is an oncoming recession sign. David Rosenberg is Gluskin Sheff's chief economist and strategist. Dave, good to see you. Happy New Year. I guess here's what I'm sure you hear a lot of in terms of pushback on this idea that we have some kind of a recession sooner than later. Well, the Treasury yield curve is still positive, even if it is flattening. Credit spreads, yes, they're wider, but they're not even where they were in 2015, 2016. And most recessions are preceded by an oil spike or employment weakening. So I guess, how would you answer any of those things?
Well, the first thing I would say about the yield curve is that I heard the same arguments back in 2006 and 2007 when I was at Merrill Lynch. And if you go back to that period, if you're focused on the 2s-10s curve, it hardly inverted at all. Then we ended up with the worst recession since the early 1930s. So I wouldn't be using the yield curve as your barometer. We already had double-dip recessions this cycle in Japan and in the euro area, and in both periods the yield curve didn't invert. So that isn't my rationale for why there's going to be a recession. Credit spreads are only in the process now of widening out sharply, and I think that through 2019, this is the first year of 4 years of a literal tsunami in debt refinancings in the corporate sector at much higher interest rates than when the debt was first taken on. So I expect that spreads probably will continue to widen in this sort of environment. So what we've seen in the past couple of months is really the thin edge of the wedge. Actually, the same sort of arguments people were making back towards the end of 2007 was that, hey, spreads have only widened out a little bit. The stock market's corrected, but it's not a bear market. The yield curve inverted in 2006, but it was minor, so nothing to worry about in 2008. So I'm hearing the same talk today that I was hearing back then. The rationale, or the main reason why I'm fundamentally bearish on the economic outlook isn't because of the stock market. The stock market is just finally bearing out the view that I've had for several months now, which is that if you're playing the probability game, we've had 13 Fed rate hiking cycles in the post-World War II era, and 10 of the cycles landed in recession. Of course, recessions that nobody ever sees, even when it's staring them in the face. So we've got more than 80% chance of recession just based on the fact that the Fed has tightened policy when you include the balance sheet very aggressively. And just since the end of the third quarter, financial conditions in general, when you're taking a look not just what the Fed has done, but finally the fact that risk premia is going up across the asset classes, the overall net tightening of financial conditions, Mike, is 175 basis points. It's as if the Fed has already hiked rates since the end of September 7 times, not just 2 times. And there's a symbiotic relationship between the financial economy and the real economy, and there's negative feedback loops. So this tightening in financial conditions that we've seen in the markets is going to end up having a cascading effect on the economy through the first few quarters of this year.
I guess the question then becomes what's already priced in, right? I mean, obviously some kind of a slowdown has been handicapped by what equity markets have done, perhaps with the corporate credit market as well. So how far along in this process do you think we are? And I guess also, even granting that, Fed tightening cycles almost always result in a recession, you just don't exactly know when. So that also has to play into when the stock market's going to have priced everything in.
Well, anybody that can time the lows and time the highs, God bless them. I've been in this business for 35 years. I haven't met anybody that can actually time the cycle. The key is really to play the middle 60% and stay out of trouble. So you ask how much is priced in. I would say that probably about half is priced in. If you take a look historically, the stock market normally is down 10 to 15% ahead of the recession. And then it's down another, call it 15 to 20% during the recession, actually bottoms just ahead of the recession ending, because of the stock market is a forward-looking or leading barometer, which it is. It will peak before the recession and then bottom ahead of the recovery. So look, if you are of the view that 10 years into this thing, after a monumental 300 basis point net tightening by the Fed, including the balance sheet, that somehow we get through this with a plain vanilla soft landing in the economy, which is what everybody was saying in 2001, and everybody was saying again going to 2008. I don't think that, I think the cycle has run its course. But if you have the view that this is a soft landing, the economy will not go into recession, then this is a phenomenal buying opportunity. If you have my view that the cycle is over, we're going into recession, it's a natural part of the business cycle, there's no sense getting overly passionate or emotional about it. Recessions do exist. And if you buy the view that the conditions are in place for a minor recession, which I think it will be this coming year, then we're basically halfway through, no more, no less.
And just to get at that idea, what you characterize as a minor recession, where would you scale it in terms of what we've seen in recent cycles in terms of duration and depth?
Well, you know, that's a great question. And that's really the best question is, you know, what sort of recession is it going to be? I don't think it's going to be a deep consumer recession or a housing recession. Housing's already gone through its downturn. Of course, that has its own leading properties. To me, it looks a lot like the early 2000s. I think it'll be a capital goods recession. The bubble this time around was not in housing and was not on banking sector balance sheets, but it was certainly on corporate balance sheets. And so I think what's going to happen in the next year, maybe the next couple of years, is that you're going to find this dramatic rise in debt service expenses, albeit from a low level. But what matters in this business are not levels, it's the change. And the change in debt service is going to absorb a large amount of corporate cash flows that will not be going into stock buybacks or dividend payouts or capital spending. It will go into debt repayment and debt servicing. That's the only way that this, this enormous $3 trillion tranche of BBB credit doesn't get downgraded, is if we go through a corporate deleveraging cycle. So I think it's going to be a mild GDP recession, but what it means for the markets it isn't that benevolent, because go back to the mildest recession of all time was in 2000 and 2001. There was hardly a decline in GDP. The consumer and housing actually hardly missed a beat. It was a capital spending recession, and it was the mildest downturn on record in terms of GDP, and yet NASDAQ went down somehow 80% on a peak to trough basis, and the S&P was down 40% in the context of a very mild recession. So the severity of the recession doesn't give you a get-out-of-jail-free card when it comes to how the markets are going to respond. You got to take a look at this, Michael, into how is it that we got to where we were. The S&P 500 quadrupled this cycle, quadrupled, in the context of the weakest economic expansion of all time. And the only reason that we didn't stop out at 1840 and went all the way to 2940 on the S&P 500 was because of the long arm of the Federal Reserve, both in terms of suppressing interest rates towards zero for so long and the rapid expansion of its balance sheet. That's the movie that's rewinding as far as the stock market's concerned.
Right.
So in terms of the depth, I don't see it's a deep recession. Getting out of it, though, that's the big question, because we've already blown our brains out on fiscal policy. Exactly. How are we going to stimulate fiscal policy? We already did that at the peak of the cycle. Should have saved those bullets for the recession. We don't have the fiscal ammunition. And historically, the Fed cuts the funds rate 500 basis points to a T to fight a recession. The starting point is going to be where we are right now, at just over 2%. So how do you fight the next recession with traditional policy bullets is going to be a very interesting development, and it tells me that it's not even going to be about the severity of this recession. It's going to be the duration and how long it's going to take to get out of it. And actually, in balance sheet recessions, like we had in the early 90s around the S&L crisis and commercial real estate, as we saw with the dot-coms back in the early 2000s and the last cycle with housing and mortgage credit, these are not the classic business inventory excess cycles where you have V-shaped recoveries and GDP responds almost immediately to the easing by the Federal Reserve. As we've seen in the past few cycles, asset cycles and balance sheet cycles are very difficult to get out of, and they take a lot of ammunition. And the starting point this time is extremely low. That's the really problem that we'll be talking about this time next year.
All right, we'll hold you to it, Dave. Thanks a lot for running through it with us. Appreciate it.
Thank you.
Dave Rosenberg. Thank you for joining us, and thank you for watching Trading Nation. Mike Santoli. We'll see you next time.